Welcome to Stress-Free Investing Analysis Personal Notes. I am so glad you're here. Today, we've got a seriously fascinating explainer lined up for you. We're diving deep into a 12-page research note on a highly intriguing company, Fineotex Chemical Limited, or FCL for short. We're going to unpack exactly what is going on beneath the surface of this specialty chemical player. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. Okay, let's look at our roadmap for this explainer. We'll start with what I call the Fineotex paradox, then we'll check out their current financial trough, dive into the massive CrudeChem catalyst, objectively weigh the key red flags, and wrap it all up with our verdict and valuation. All right, part one, the Fineotex paradox. So, Fineotex is a formulation-led specialty chemicals company. Basically, they take basic chemicals, apply their proprietary tech, and pump out high-performance products, mostly for the textile industry. And right now, they present a glaring contradiction. I mean, on one hand, you've got a company with a literal fortress of a balance sheet, absolutely zero debt, zilch. Plus, they're sitting on a massive pile of net cash and investments, roughly 335 crore rupees. By all traditional metrics, their financial health is incredible. But then, you look at how the stock is actually doing. Yeah, the stock is down a staggering 78% from its pre-bonus equivalent all-time high. 78%. It has just massively underperformed the Nifty 50 over the last year. So the million-dollar question here is, why is a zero-debt company with a mountain of cash getting absolutely punished by the market? Well, let's find out. That brings us to part two, financials and a trough. To really understand the market's reaction, we have to zoom in on their earnings cycle. Historically, FCL has been an absolute compounding machine. I'm talking a 10-year profit after tax compounded annual growth rate of 26%. And over a 5-year period, an exceptional 40% PAT-CAGR. But look where we are right now. In FY25, their PAT actually shrank by 10% year over year, and revenue dropped by 6%. They've been slammed by textile pricing weakness due to global tariff concerns, those crazy Red Sea disruptions, and delayed scaling in their newer segments. Their earnings are quite literally stuck in a trough. And this earnings dip creates a really harsh knock-on effect. Their return on capital employed, or ROCE, dropped sharply from a top decile 39% in FY24 all the way down to 23.8% in FY25. But here's the key takeaway you need to remember. This compression doesn't necessarily mean the business model is broken. It's actually more of a mathematical artifact. The numerator, which is the profit, dropped while the denominator, the asset base, expanded massively because of recent capital raises and acquisitions that just aren't earning their keep yet. Moving on to part three, the CrudeChem catalyst. So, Fineotex is currently going through a pretty painful but potentially incredibly lucrative transformation. We can basically contrast their two worlds. On one side, you have the legacy textile business. It enjoys super high EBITDA margins of around 24 to 26%, but growth has been completely flat. On the flip side is their big pivot, jumping into the U.S. oil and gas chemicals market through their recent acquisition, CrudeChem. The total addressable market here is a whopping $11.5 billion. The catch? CrudeChem currently operates at very low margins, just around 7 to 8%. Let's break down the math on this deal, because it's honestly staggering. FCL grabbed a 53% stake in CrudeChem for just $11.5 million. But get this, CrudeChem generates $68 million in annual revenue. They basically paid 0.14 times revenue. It's an exceptionally cheap acquisition. The entire thesis here, and why this matters so much, is whether Fineotex can use its formulation efficiencies to drag CrudeChem's margins up from that 7% to a target of 12 to 15%. If they pull that off, it's a total home run. But in the short term, dragging those low margins onto the balance sheet is weighing down FCL's overall profitability. Which naturally leads us to part four, key red flags. As promising as that CrudeChem pivot sounds, we gotta look at the other side of the coin. There are definitely a few red flags we need to monitor. First, a governance flag. Back in 2018, the promoter, Sanjay Tibruwala, was fined by SEBI for an IPO-related non-disclosure. Sure, it's in the past, but the market always applies a discount for that kind of history. Second, a recent preferential issue was severely undersubscribed. They aimed for 280 crore, but only managed to raise 92 crore, which tells us institutional investors probably balked at the high issue price. Third, the promoter's skin in the game has steadily declined from over 72% down to about 62.88% over the last 8 years. And finally, there is massive execution risk in trying to integrate a U.S. business from India and fixing those single-digit CrudeChem margins. Because of all these risks and the fact that we've seen 6 straight quarters of year-over-year profit decline, the market is basically in wait-and-see mode. As the source material bluntly notes, earnings remain in trough territory. So the absolute critical catalyst to keep your eyes on is the upcoming Q4 FY26 results expected around May 15, 2026. This is going to be the first quarter with full CrudeChem consolidation, and we desperately need to see if those margins are finally starting to tick up. All right, the final stretch, part 5, verdict and valuation. So how exactly do we price a cash-rich, high-margin business that's elbow-deep in a low-margin, high-growth transition? The ultimate question on the table. Is Fineotex Chemical Limited a buy, a hold, or a sell at current levels? Let's look at the objective scenario analysis from our research notes. The base case targets 40 rupees, which represents a solid 38% upside. That assumes earnings normalize and those CrudeChem margins actually improve. The bull case looks at 55 rupees, a massive 90% upside if their execution is absolutely flawless. But the bear case is a very real 18 rupees, which is a 38% downside if the U.S. expansion struggles and the textile market stays weak. There is some real, tangible symmetry in the risk-reward here. And that brings us to the final verdict, based on the source analysis, hold, and watch, giving it a quantitative score of 68 out of 100, or a grade C+. Why hold? Well, because the core India business's intrinsic value is calculated right around the current market price of 28.9 rupees. It's fairly valued today. You're essentially getting the CrudeChem optionality for free, but remember, it comes heavily packed with execution and governance baggage. The smart move, highlighted by the research, is to hold, wait for those upcoming quarterly results to confirm a true recovery, and maybe consider buying on any dips below 24 rupees. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next explainer. Thank you for watching and keep your investing stress-free investing.